Hi everyone, welcome back to a brand new video. I'm Ryan Mossman. I'm a real estate agent located in Southern California, in Ventura County, and today we're going to dive into mortgage rates and the future of mortgage rates. A few years ago, it was very common to get a 3% mortgage rate or even under 3% mortgage rate. So I'm going to pose the question, when will we have 3 or even 4% mortgage rates again? Let's check it out. To understand mortgage rates, first you have to understand why mortgage rates are set where they are set. And I did a video about this a few months back that you can check out. I did a deep dive on how mortgage rates are set, so please check out that video. I will have it linked below. But loosely, mortgage rates follow something called the 10-year Treasury yield. As the yield on the 10-year Treasury goes up, so do mortgage rates. And there are a variety of economic factors that affect the Treasury yields and the spread between the Treasury yield and the mortgage rate. A few years ago, when mortgage rates were very low, the Federal Reserve was doing something called quantitative easing, which means they were flooding the market with money. And they were doing this by buying up Treasury yields. When the Federal Reserve is buying up Treasury bonds, it causes the price of these bonds to go up. When the price of a bond goes up, the yield goes down. Today, we have the reverse. We have the Federal Reserve selling all the Treasury bonds that they had bought, which is causing the price of the bonds to go down and the yields to go up. When yields go up, mortgage rates go up. So the bond market has a huge effect on all borrowing costs, whether it be mortgage rates, credit card interest rates, when you buy a new or a used car, the rate that you get on that. Basically, everything with interest is going to be affected by the bond market. And in recent years, the U.S. has been doing an excessive amount of borrowing to cover the deficits that we put ourselves into with all of our spending, with all of the U.S.'s spending. So the United States deficit in all the spending that we're doing right now and in recent years is causing an oversupply of Treasury bonds. And traditional buyers of those bonds like China and Japan are just not buying them as much anymore. So for example, 10 years ago, China and Japan, they bought about 22% of our Treasury bonds, but in recent years, they're only buying about 7% of our Treasury bonds. So the US government now is having to offer higher yields on these bonds just to get buyers, and they need people to buy these bonds because they need the money. So basically a bond, if you don't know, is the government promising to pay someone back with interest if you give the government money now. So when nobody wants to buy these bonds as frequently, the yields on these bonds have to go up because the US has to sell these bonds and people are only going to buy them if they get a certain return on their money. So the fact that not as many investors are buying these Treasury bonds as frequently is a sign that yields on the 10-year Treasury are going to continue to go up, which means that 30-year fixed rate mortgage rates are also going to continue to go up. So I found this great snippet from an episode of CNBC's Fast Money, and they had on Jim Bianco, who's a renowned analyst from Bianco Research. He thinks that the yield on the 10-year Treasury bond is going to surpass 5% and could even get as high as 6%. So his theory is that the Federal Reserve is going to continue its pause on the increase of the federal funds rate. But if inflation is continuing to go up while they are pausing their rate increases, this is going to cause more people to steer clear from Treasury bonds. And when people don't buy Treasury bonds, this causes yields to go up.
Market rally may be on borrowed time. Our next guest sees a significant rebound ahead in the benchmark 10-year yield. Market forecaster Jim Bianco runs Bianco Research. Jim, great to have you with us. We were just saying how maybe it's all about rates. And if that's the case, then this is bad news for investors who are bullish, who are long. You're saying 5.5% is where we're headed on the 10-year.
Yeah, I was on with you a month ago and I said, the 10-year's going to 5.5%, and it's been a terrible month for that call, but I'm still there at 5.5%, say in the first half of 24. And the reason is I don't think we're going to have a recession. And I think that the inflation rate is bottoming somewhere around 3%. So if you've got 2-ish to 3-ish growth in the economy, which is what it's been for the last 5 quarters and projected to be in the current quarter, and say 3 on inflation, that's 6% nominal growth. I put a little fudge factor in there, and I got 5.5% on the 10-year note because the 10-year yield should somewhat approximate where nominal growth is. So that means that the economy, interest rates should probably bottom out here in the next month or so and continue to move higher.
So as you saw in the video, it is an interesting theory, right? You have to take in the growth of the economy, the GDP, and the inflation to get to a fair market value on the 10-year Treasury bond yields. But if GDP continues to go up and inflation continues to go up, this will cause the yield to continue to go higher just to reach fair market value so that people are getting a modest return on their investment. Next, we're going to check out a snippet from another video. This is Peter Zeihan, and he's talking about the global demographics. And in this snippet, he's talking about the United States demographics.
Let's talk about us for a minute. 2 big takeaways. First of all, the baby boomers, largest generation we have ever had. And as of the 4th quarter of last year, half of them had already retired, which means that half of them have already liquidated their savings. And that is why capital costs have increased by a factor of 3 in the last 3 to 4 years. It's demographics. It's not the business cycle. It's not the Fed. It's not the Biden administration. It's demographics. And capital costs will continue to go up as the rest of them retire and liquidate their savings. And that will last until another large generation ages into that late 50s group. That will be the millennials, but that will not happen for another 10 to 15 years. Now, there's a couple good things here and a couple bad things. The good things, all the millennials 10 years from now are going to be having midlife crises, and that will be delicious. But it means we have to wait till after 2035 before capital costs start going down at all. This is just the environment we're in now.
So in this video, Peter Zeihan highlights that the retirement of baby boomers is going to create a huge economic shift. So baby boomers are transitioning from a group of saving and investing to now retiring, which means they have to draw from their savings, and they're typically going to put their money into safer investments like bonds, real estate, and other safe investments, and they're going to get away from higher risk investments like stocks. So as baby boomers retire, they start to draw on their savings. They're taking money out of economic institutions like brokerages and banks. This means that those institutions have less money to lend out for mortgages, for example. Because they have less money to lend out, this means that they can charge more on the money that they do lend out. So it is going to be more difficult to borrow money because there is less of it, and it is going to be more expensive to borrow money because there is less of it. So there is a contradiction in this. Because baby boomers are retiring, they are going to put their money into safer investments like Treasury bonds. And when people buy Treasury bonds, this typically causes Treasury yields to go down, which also causes mortgage rates to go down, right? Even if Treasury yields go down, the economic institutions can still increase the spread between the mortgage rates and the Treasury yields to help cover the costs or to help cover their losses because they have less money to lend out. So Peter Zeihan's hypothesis is that we are going to have much higher borrowing costs for a lot longer. He doesn't think that we will have 3 or 4% mortgage rates maybe ever again. Another factor to think about is that baby boomers are putting their money into safer investments, right? Another safe investment that they will consider is real estate. So as these baby boomers have money to put into safer investments, they may think about buying up residential properties. As we already have a shortage of supply for millennials going into the housing market, many of which are still trying to buy their first home, they may face increased competition from baby boomers who are trying to put their money into safer investments. So when we have competing generations, baby boomers looking to put their money into safer investments like residential real estate, and millennials still hoping to buy their first home, this is going to have a dramatic impact on the housing prices. So unless we have a huge increase of supply somehow in the real estate market, chances are that real estate prices, regardless of what the mortgage rates are set at, are going to continue to go up into the future. Now, of course, this is going to vary from region to region. So for example, I live in Ventura County. Ventura County has the worst housing shortage in the US. So that is going to mean that housing prices are probably only going to continue to go up in my metro. Barring some sort of black swan event, I do not see any economic factors that are going to cause real estate prices to come down anytime soon. If any sector in the real estate market is going to get hurt from this higher cost of borrowing and the influx of baby boomers into the housing market looking for safe investments, it's likely going to be the higher end properties and luxury real estate. This will feel the brunt of these economic conditions. Whereas the demand for the more affordable homes, single-family homes, first-time homes, those types of properties are probably going to continue to go up because the demand for those properties isn't going anywhere anytime soon. So although higher mortgage rates typically means lower real estate prices, when mortgage rates go up, it typically means that we have less buyers, which means that people are forced to sell their properties for less to entice the few buyers that are out there. But in this market, because we have such a short supply for millennials and other first-time home buyers, this means that even in a high interest rate market, we still are seeing an increase in real estate prices. Now, obviously, this is going to vary from region to region. There are some areas in the country that were greatly affected by the pandemic. For example, Boise, Idaho, and Austin, Texas. These areas had a huge influx of people, which caused the housing prices to go up drastically. Since then, we've seen a bit of a reversal. A lot of people who moved to those areas are now trying to sell their homes and move back or move again, which is causing the home prices in those areas to come back down to earth. But the majority of metros are seeing home prices continuing to go up, even though we are in a high interest rate environment. And based on the information that I've shown you today, it seems that we're going to be in a high interest rate environment for many more years to come, potentially. So it's a complex situation. It's ever evolving. You got to keep an eye on the data, which is why I'm here. I'm here to do it for you. So if you are in the Ventura County area, or if you are looking to move to the Ventura County area in Southern California and you need advice or you need real estate help, please reach out to me. I would love to help you. You can find my contact information linked below or visit my website, rmossman.com. Thank you all so much for watching. I really appreciate your support, and we'll see you again very soon.